Well, let's hear it from Mr. Abhay Soi, who's the chairman and managing director of company. What lies ahead for the company and what was the reason we've seen the decline in the net profit? Listen in.
So I think, we've had a revenue growth of 35% and we've had an EBITDA growth of 32% for the quarter. If you take out the exceptional one-time item, which was essentially 74 crores that we had to pay to YEIDA, which is the Yamuna Expressway Development Authority, for transfer of shares to us with respect to the JP hospital acquisition transaction. And this is clearly a one-time item. Ex of that, we had a 15% growth in profit after tax. Of course, we had a net cash of 300 odd crores in the previous quarter. And in this quarter, we have about a 1600 crores debt. And this debt, 1600 crores, was essentially taken to fund the 1850 crore JP transaction that we did in October this year.
Got it. So also, let us talk about EBITDA. Your EBITDA per bed on an annualized basis was at 73 lakhs. Now, if I compare this with Q3 FY24, it was 75 lakhs in Q3 FY24. Any reason for the decline? And most interesting part is the scale up expected in EBITDA per bed when it comes to your new units.
That's right. So we've done 3 acquisitions last year. Nagpur and Lucknow, which we acquired in 9 months ago. Obviously they would have lower Arpops and lower EBITDA per bed, which were expected to pull down the overall EBITDA per bed and Arpop. But having said that, we have to look at it in terms of ROCE. What we've also been able to do as far as the performance is concerned, demonstrate very good efficiencies because we've more than doubled the EBITDA emanating from these 2 acquisitions in less than 9 months. On top of that, we launched our Greenfield, which was in July, about 6 months ago. And I'm happy to sort of bring to your attention that we've broken even in less than 6 months. But obviously the EBITDA per bed is going to be 0 because we've just broken even. And, again, the Arpop will be lower. But having said that, we've been able to do this in a record time of 6 months. Normally, the period for break-even on greenfields is anything between 18 months to 2 years.
Right. So this break-even EBITDA, I assume you're talking about Dwarka.
That's right.
So what are your plans there now? What is the target that you've set now, considering the unit has been a EBITDA break-even?
So, well, it's been a very quick ramp up. It was supposed to be a 290, 280 bed hospital. We launched 140 beds that we've already achieved 76% occupancy. Now we are in the ramp up stage. We are already launching the balance beds. I think we'll be doing this within this month. Subsequently, and I see this perhaps same time next year being capacitied out entirely. So we need to plan for further expansions over there, which we are in the works right now. Because any expansion that we do is going to take us another 2 years, and we need to put it in works right now. So we're looking to expand it by another 200 to 300 beds going forward as well. So it's a very quick ramp up. We're expecting strong results from there, but it's been far better than what we anticipated internally as well.
Got it. And also, Mr. Soi, your Arpop, if I were to see historically, if you see that has grown almost 8 to 9%. Now, but this quarter, now quarter 2, I assume that it is lower when it comes to Arpop, but quarter 3 is good when it comes to Arpop. But your Arpop did come down marginally. Is this because of the new units that has come online? And what is the sustainable Arpop that you are expecting going forward?
So that's right. I think you need to look at it really on a Y-on-Y basis, year-on-year basis. And overall, whilst this may show a picture of a 1% reduction in Arpop, the existing units, that is, X the new units, they've grown at 8%, which has been the growth in the past as well.
And also, your Arpop in new hospitals, are they growing in double digit?
No, absolutely. I think our revenues have been growing in, almost 50 odd percent on a year-on-year basis. Our EBITDA, we more than doubled. It's more than 100% growth in EBITDA since we acquired them.
Okay, and let's talk about the occupancy. In Q3, so normally you have a lower occupancy when it comes to Q3 versus Q2. This is just sequentially that I was talking about. But what is your target when it comes to occupancy? Because Nagpur occupancy has also gone down. I mean, I think in Q2 it was around 90 odd percent. Now it is in the range of 70, 75 odd percent. So what is the peak occupancy that you are expecting at your existing units?
Again, occupancies are normally higher in Q2 and Q4. Q1 and Q3 particularly because of the holidays, Diwali, New Year's, etc. Doctors on leave, as well as patients tend to postpone their surgeries or prepone their surgeries. So we see that lower sort of occupancy impact. This year, having said that, we've had a lesser of impact as far as North India is concerned. Diwali time, typically our occupancy goes down to 70%, but this year it was 76%. On an overall basis, if you see at the consolidated level, on a year-on-year basis, our occupancy has grown by 5%. So it was 73% this last year. I think it's about 77, 78% this year for this quarter, which has been a good occupancy as far as this quarter is concerned.
Got it. Also, now speaking about your international business, your international patients, what is the share over there and what are the trends that we are expecting? And also, just wanted to know your Bangladesh contribution as well.
So we have about 10 odd percent of our patients are international patients. On a year-on-year basis, it's grown by 28%. On a quarter-on-quarter basis, grown by 8 or 9%. But really the number to look at is on a
Right. Meanwhile, the economic survey for 2026 has been tabled in both houses of the parliament. Let's take a very quick look at some of the key highlights that are coming in from this year's economic survey. Global economy is expected to grow by it has grown by about 3.3% in 2023. The IMF projects global growth to average about 3.2% over the next 5 years, modest by historical standards. The Eco Survey does talk about global challenges continuing well into the next year as well. Inflation rates are trending downwards steadily, the Eco Survey says. Despite the economic uncertainty globally, India's real GDP growth of 6.4% in FY25. Now, this is as per the first advance estimates that we had received earlier this month, does remain close to the decadal average. So the economic survey does believe that despite the fact that we have seen lower than what was previously being estimated GDP growth for India, the Indian economy does continue to show a fair bit of resilience. Now, keeping in mind the upsides and downsides to growth, real GDP growth for FY26 is expected in the range of 6.3 and 6.8%. Now, that's one of the big takeaways from the Eco Survey that's just been tabled. Let's quickly get in Dheeraj Nim, economist and FX strategist at ANZ Research. Hi, Dheeraj.
Hi, Pallavi.
So I know we're still going through the details of the economic survey, but of course, one of the key details that was being awaited was the range for GDP growth that the CEA would give, like he had given in the last Eco Survey. That's been projected at 6.3 to 6.8% for FY26. Is that broadly in line with estimates? Was the expectation that there would be somewhat of an upturn by the next fiscal year, at least, given that we are in the middle of an ongoing slowdown? Tell me your quick thoughts from this projection.
I think it's a very credible range. So I am projecting growth in FY26 at 6.5%, which is right in the midpoint of this projected range by the Chief Economic Advisor. I do think that in FY26, given a number of factors, growth will still remain in the 6.5% ballpark and somewhat below potential. So I think from a policy perspective, of course, there is a need for policy support even going into FY26. So I think it's a credible range, something that we will see play out over the next year.
Okay, all right. So, given the projections that are coming in for GDP growth, and given that there is a fair bit of consensus that the government is going to stick to its fiscal consolidation path for FY26, so we're possibly looking at fiscal deficit at about 4.5% of the GDP or so. So, how does that sort of juxtapose in a slowing economy? It does make the government's job that much more difficult, right?
Well, I think so, and I agree with it. Look, the economy is in a bit of a negative output gap, if I were to sort of voice my own view. And in that scenario, if the government is having to consolidate the fiscal deficit, then the fiscal impulse to growth, as we economists call it, will be negative. So in effect, the budget impulse to growth will be slightly negative. So instead of a driver, budget could actually be a bit of a drag on growth. Having said that, I do think that budget is not just a one-year document. It sort of also creates a vision for the medium term as well. And given where the fiscal deficit ratio, public debt ratio, debt servicing costs for the central government are, and they are very elevated, I do think that sticking to the glide path is still the most important thing for the central government finances. So I think at that minor cost to growth, as far as fiscal impulse to growth is concerned, I do think that government should stick to its glide path.
Okay, all right. Some comments on inflation in the eco survey. While there are no projections by the government as such, it does say that the RBI and international institutions do expect, inflation to come in closer to the 4% target and gradually align with that target in FY26. Is that broadly in line with expectations? Can we see a 4% figure or an inflation figure of a tad below 4% maybe? When is the expectation?
Okay, so a couple of things here. The RBI's own projections show that the CPI inflation will align with the 4% target by Q3 2025. I think it could happen sooner. If you look at the daily vegetable prices, because vegetable inflation was what was keeping headline inflation quite elevated. If you look at the daily vegetable prices over the course of January, headline inflation is already tracking at about 4.2, 4.3%, which is substantially below the readings of the previous few months. So I think that if food continues to, continues on a downward trend, food inflation continues on a downward trend, we could see the 4% figure in a durable manner sooner than the RBI projects currently. And I think that this view is very on point.
Right. Okay. Well, the eco survey also talks about how the focus needs to be on domestic growth levers. That's, a compulsion going forward. But for more details, let's also quickly go to Shrimi, who joins us with more on the eco survey. Hi, Shrimi. What have you been picking up?
Hi. In the July budget, the eco survey already pegged the growth between 6.5 to 7%. That was the range. Now it's gone further conservative, and the growth rate is between 6.3 to 6.8%. Now, couple of growth drivers survey is talking about, and I wanted to highlight that. Still, I'm going through the details of it, but the couple of details. One is, of course, that government should focus on the agriculture, as it remains a strong growth driver for the economy and for the next fiscal year as well. So there government wanted to have a focus. Second important point, survey is mentioning about deregulation. The survey is underlining that deregulation is very important in terms of having a ease of doing business. In fact, specifically for the manufacturing sector, which survey is seeing it, and it remains a concern even for the next financial year. And deregulation is required both at the state and local regulation point, especially in terms of land licensing and all the clearance, which at present causing a lot of issues in the businesses, particularly in the manufacturing sector. Third important point, survey is talking on and touching upon on the employment. In fact, it's saying that artificial intelligence is one of the area which government should look into, because somewhere it's posing a risk to the overall employment. So these are a couple of points which survey is mentioning, and in fact it also touches upon the global trade, which has continued to see the down risk, looking at the present geopolitical scenario, and manufacturing sector, as I mentioned, that it's remain a concern in fact for the next fiscal as well. And you remember that survey is an important document which lay a foundation for the budget, setting a tone for the budget. So we may see tomorrow some sort of fiscal stimulus from the government, because survey again highlighting that about the urban consumption which requires government attention.
All right, thanks a lot for that, Shrimi. Do stay on. I'm also joined by Upasana Chatra, Chief India Economist at Morgan Stanley. Upasana, thank you so much for speaking to us. Now, we're just unpacking the eco survey. I'll my first question to you as well is regarding the growth forecast that's been put out in the eco survey, 6.3 to 6.8. Do you find that broadly reasonable? And also to add to that, how much of a cause of concern do you find that figure to be? Because, while we are in the middle of a slowdown currently, the expectation was that next year might be better, but it does not look like it's going to be exponentially better. Any thoughts?
Hi, Pallavi. So I think on the growth side, see, our number for fiscal 26 is at 6.5%. So pretty much in between or in the range of what the eco survey is suggesting at 6.3 to 6.8%. I think it's a realistic range that the government has gone ahead with. We should, I think, remember that external factors and external developments are not probably going to be very supportive of growth. And the growth alpha is likely to come only from domestic demand. So in that context, I think starting with a range which is in this sort of mid-6 levels as a target for fiscal 25 is probably more realistic. And that bodes well from a fiscal math perspective as well. That is, you're probably going to get numbers which are going to be more realistic from the union budget that is likely to be the numbers that are that we will likely see tomorrow for fiscal 26 as well.
Yeah, so I wanted to ask one question that, post-pandemic, if you see the growth range like GDP numbers, for 3 consecutive years, we have seen growth reaching, above 7%. It touches on above 8% also. Even the last fiscal FY24, we have seen the growth is, slightly over 8%. So I wanted to ask, since second quarter seen 5.4% growth, RBI also slashed that. Do you think that government should now, change the strategy and the whole economic policy, at this point of time?
So I think, for growth to improve, there were transient factors that played their part in the number that we saw in September quarter. And there was also the role from sort of unintended, but quite a bit of fiscal consolidation that happened in this fiscal 25, because government spending targets have been tracking weaker than what they've budgeted. And that, I think, has been a key reason. Alongside, we've also seen some amount of monetary tightening, which has its own role to play in the cyclical slowdown. But as we speak now, and as you see for the outlook, monetary policy is likely pivoting. We are seeing more aggressive measures from the RBI to address the liquidity deficit. We probably likely to see a rate cut in the next policy. That's what our view is. And from the fiscal policy side as well, yes, the fiscal deficit is consolidating still, but probably we're going to get the slowest pace of fiscal consolidation in fiscal 26. Our estimate is that about, say, 30 basis points to 4.5% in fiscal 26. And incrementally, if you were to see, government capex spending should likely be picking up from here, just because April to November the trends have been so weak. So there is a need to catch up, at least to meet, and it's very unlikely that they meet the budgeted numbers for fiscal 25, but nevertheless to catch up and to cover some ground. And in going into fiscal 26, we expect that at least in fiscal 26 they will meet the targets that they set. So I think the fiscal drag that we saw, which was meaningfully higher in fiscal 25, is going to be behind us, and that will by itself be supportive of growth. So we don't think that there is a need for the government to sort of give away on the fiscal consolidation roadmap, but I think it's more about actually execution and implementation and keeping the focus on, especially on meeting with the capex numbers.
All right, coming to you, Dheeraj, I do want to ask you, the eco survey, whatever we've been able to glean from it so far, any indications in terms of budget expectations for tomorrow, given maybe, for instance, the growth range, for instance, is that reason enough to expect some kind of a stimulus coming in tomorrow?
Look, like I said, the imperative to consolidate the fiscal deficit is very much there. So if you go along with fiscal prudence and fiscal credibility, which has probably been the hallmark of the current government for several years, I think a GDP growth rate, nominal GDP growth rate, anywhere between 10 to 10.5% will be a very credible number. Now, with that kind of GDP growth underlying your fiscal projections, and if you still remain conservative on revenues, for example, your tax buoyancies, etc., I think the government will still have to cut back their spending by about 30 to 40 basis points as a share of GDP. And that by itself tells you that you probably do not want to expect a big stimulus coming out of the budget for the aggregate economy. But I do want to highlight that, the budget can also work with non-fiscal measures, such as about regulation and, ease of doing business, etc., with which it can create a higher medium-term potential growth. And I think this is the perfect opportunity for that when your own growth has slowed.
Right, all right. Thank you so much, Upasana and Dheeraj, for taking time out to speak to us. We will continue our coverage of the Eco Survey once we go through a few more details. But till then, do stay tuned to NDTV Profit for our continuing coverage.
This is the day that shapes the future of 1 billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs and what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you. STT. STT definitely needs to change.
Old tax regime.
The 1991 budget was truly a game changer.
I mean, the rest is history.
Union budget.
Budgets. General elections.
Union budget.
2 more, Yashwant Sinha and P. Chidambaram.
Arun Jaitley.
Arun Jaitley, I'd have to say.
I think Manmohan Singh for sure because of the iconic 1991 budget speech.
STT. STT definitely needs to change because now if returns are not that good, it'll start pinching people.
Income tax.
I think income tax because that's what matters to me.
Old tax regime.
Depends. Old tax regime currently.
I would say healthcare and education.
I'd believe infra.
Oh, certainly more allocation towards infrastructure. That's what's keeping the wheels turning right now.
Game changer, but not in a positive way, was the budget when farm loans were waived off.
There are a couple of them actually. 1991, Manmohan Singh. That was the budget which opened up the economy. Then 97, Chidambaram, who reduced the tax rate from 40% to 30%. In 2001, I think, if I'm not wrong, Yashwant Sinha, who reduced all the duties on customs that led to the computer age or the IT age taking off in India.
I think the budget in 2022, where Capex was done in a very big fashion.
There were several actually. 1991 was something that stands out, and I mean, the rest is history.
As I said earlier, Manmohan Singh's 1991 budget, I was a very young child at that point in time. But as far as I understand from reading about it and watching a lot of commentary from experts about it, 1991 budget was truly a game changer.
Well, the union budget is right around the corner, and we get you some of the major wish lists according to Bajaj Broking, the key sector expectations, as well as the 3 key stocks that you should watch out for in this particular budget. Let's start with, some of the key budget expectations in terms of sectors. In terms of banking, they have mentioned that, they're expecting no favorable terms in terms of deposits to come in, but capital infusion for PSU banks as well as insurance companies will be something to watch out for. When you move on and look at the other key expectation from banking, they are expecting that the focus of the banking and the financial space will be on sectors such as cement as well as the metals, which haven't done too well over the last 2 years. Import duty changes to support any kind of domestic production will be something to watch out for, especially for the metal space, because we are expecting and hearing rumors as well in terms of some anti-dumping duties on metals coming from China.
Hello and welcome. You're watching Top Trades on NDTV Profit. I'm Somit Sarkar and I'll be your anchor for the next half an hour of trade. Well, the Nifty continues to soar higher. It's about 1% up. It has crossed the crucial level of 23,500 in the that's the benchmark index. But when it comes to F&O stocks, we are seeing a strong traction on Kalyan Jewellers after the company reported a strong set of numbers. Navin Florin is up 7% This is on the back of strong numbers and double upgrade coming in from Jefferies. They have upgraded their rating to buy from underperform. Similarly, Sant is up around 7% in trade, and this is after JP Morgan upgraded the rating on this counter to overweight from neutral. Apart from that, it's IRB Infra, Tata Consumers, BHEL, which have been gaining anywhere between 6 to 6.5%. When it comes to cash stocks, it's Gulshan Polyols, which has hit an upper circuit of 20% in trade, followed by Pokarna, which is up 15%, Sasken Tech, that is up around 15% in trade, and then there is Ola Electric, Suven Life, and Wockhardt, which have gained around 10% in trade. But on the losing side, we have JSPL. Now, the numbers are pretty much in line with what the street was expecting, but it was the capital expenditure. In fact, the surprise capital expenditure, which has led to a 7% downtick in the share prices. Then it's followed by Divi's, Bank of Baroda after a weak set of numbers. KPIT Tech, Sun TV Network, they are down anywhere 3%. Voltas is falling for the second straight session. It is down around 2%. Yesterday, the stock was down more than 10% after the company reported a weak set of numbers. On the cash side, if you look at on the top losers, not much of a name, but Whirlpool is down again 9% in trade. Yesterday, the stock had hit a lower circuit of 20%, so 30% down in 2 trading sessions. Vedant Fashion is down 8% after reporting a weak set of numbers. Anup Engineering is down around 8%, and then that's Raymond Lifestyle, which is down around 7% in trade. But though the benchmark index is up around 1.2% in trade, Nifty is set to decline for the 4th consecutive month. Now, this will be the longest losing streak on a month-wise if you look at for the benchmark, at least in the last 4 months now, at least since in the last 23 years. Now, last time when we had seen a 4 months continuous decline for the benchmark, that was back in September 2001, and since then never has the index declined for the 4th consecutive month. Now, we have seen multiple times the benchmark declining at least for the 3 consecutive months, and to be precise, it has been around 11 such instances where the benchmark index has declined for around 11 consecutive months. For 11 times, in fact, they have declined for 3 consecutive months, and out out of those 11 times, 3 times we have not seen much of a positive return coming in the index over the next 2 or 3 months, but the remaining 8 times we have seen a solid gain coming in. So we'll have to wait and watch how the benchmark index reacts now going forward. But Jefferies also came out with this note today in the morning where they're saying that the long-awaited market correction is now underway for the last 126 days. Now this is the second longest correction that they have seen out of the 10 corrections that they have seen in the last 10 years. Now they're saying the markets have declined around 15% and the current correction is in line with the average correction that they have seen in the last 10 years, and they're saying that Nifty should bottom out before Feb 7. Now Feb 7th is the RBI MPC meet, and they're expecting no tax surprise to come in the budget and RBI to be pro-growth, to have a pro-growth stance in their MPC meet. And based on these two factors, they're expecting that the Nifty would bottom out on 7th of Feb. Apart from this, they're bullish on the rate sensitive. They're expecting them to do well in the near-term rally. And they're saying that 12-month outlook depends on the FPI flows and strong equity supply, which could offset by domestic flows as well going forward. So, well, we need to wait and watch what happens with the benchmark going forward. Well, moving on, a host of stocks that have been buzzing in trade, and a host of stocks that have been buzzing in trade. In fact, Kalyan Jewellers did join with us today in the morning, and the management was quite positive on the growth outlook as well, and that's the reason why the stock is up around 11% in trade. Navin Florin, as I was mentioning, Jefferies had done a double upgrade on the stock, and Citi has also hiked the target price. Pallavi will be joining us now to bring us the highlights of the economic survey.
Right, now, the eco survey has just been tabled in both houses of the parliament a short while back. The most important takeaway is that GDP growth has been estimated to range between 6.3 to 6.8% for FY26. Now, this would mean sub 7% growth for India's economy for the second straight year. Geopolitical risks have been highlighted. The eco survey says that they remain elevated because of ongoing conflicts and tensions and continue to pose significant risks to the global as well as the national outlook. However, given the external scenario, the eco survey does say that the sectors domestically reveal that they're all performing well. Agri remains strong, consistently operating above trend levels. The industrial sector too is currently above its pre-pandemic trajectory, and the robust rate of growth in recent years has taken services as well to trend levels. So given the global economic scenario, India's GDP growth continues to be commendable. That is what the eco survey says. Some of the other focus areas are AI, agriculture, MSMEs, and we're going to be watching out for what these cues might indicate in terms of budget expectations tomorrow.
Well, Sami Hotels announced their Q3 numbers. The net profit growth and the net profit number came in at close to 23 odd crore for the third quarter of FY25. My colleague Anushi caught up with the company's chairman and managing director and chief executive officer. Let's listen into that conversation.
So first of all, I think the quarter three played out exactly as we had expected it to be. Just one correction, if I may. Because we own largely business hotels, we have traditionally seen quarter four being the strongest quarter. So quarter three was clearly very strong, as you said, that it's 10% growth over last year. But we also see quarter four trending pretty strong.
So, Mr. Jharkhandwala, I want to understand from you for Q4, what are the strong levers that you're expecting? And also, if you can give us an outlook on what FY26 can mean for the business in terms of where the revenue growth is concerned, and as well as if you can give us an outlook on the margins.
So quarter four is obviously strong also because of the fact that we don't have many holidays in this quarter. Quarter three has Diwali, Dussehra, Christmas, New Year. Whereas quarter four, after people come back from their annual vacation, we see pretty good run from then till 31st March. So that's just basically a statistical fact which helps us do better in quarter four. The second is there is a higher density of events in quarter four. That also helps. You got events in Bangalore, you got events in Ahmedabad, there are events in Mumbai. So all of these events also help shore up the demand in quarter four. And then general uptake in office space and continued growth in aviation is helping a demand for business hotels in key cities. So that's really as far as the current quarter is concerned. For the next financial year, we think that the businesses will be able to maintain a high single digits to early double digit total revenue growth. And in terms of margin in our business, we reported about 37.9% margin in the last quarter. In the next fiscal year, we have 2 or 3 things which will help us improve the margin. First is the acquisition we had made just prior to the IPO. That's playing out really well for us, and we expect that portfolio margins to cross 40%. And the second is we'll see further reduction in ESOP expenses. And the combined impact of that should help us cross the 40% reported EBITDA margins in the business in FY26.
Absolutely. In fact, I was just going to address the employee expenses now. They have seen a significant downtick in this quarter also. Want to understand from you, you've mentioned about the 2-3 levers which are there in terms of the expansion in margins that can help you. That is the integration of the various acquisitions also taking place. I want to understand the developments, the timelines on when these acquisitions would be on stream for the business and when it can start reflecting in the revenue and the margins as well.
So if you see what we've done in the last 6-8 months is we've done 2 acquisitions. One is for our operating hotel in Bangalore, which is going to be converted to a part of the Tribute portfolio by Marriott, and we're adding a Westin hotel in the same development. And then we have an office building which we are converting to a W hotel in Hyderabad. In addition to that, we have fair bit inventory addition happening within our portfolio in the Holiday Inn Express platform in large hotels like Sheraton Hyderabad and Hyatt Regency Pune. So we expect that all of these additions will start adding to the revenue starting financial year 2026 and actually continue every year till almost FY29. The big impact would be that our upscale portfolio, which operates at almost 2x revenue per key than the portfolio average, is going to double from about 1,000 rooms to almost 2,000 rooms. And that will have a substantial impact on our top line. And in terms of margins, as we keep adding revenue, and of course, as you've said, we've largely rationalized the operating structure, we expect the business to maintain, more than 40% EBITDA margins on a consistent basis.
Okay, that's quite an optimistic outlook that you have. So you've mentioned about the growing focus towards the upper and upper scale hotels that is there. In fact, if you look at the RevPAR, that's the revenue per available growth, in the last 2-3 quarters, the number has ranged from 13 to 16%. So considering more of these hotels, well, after they are rebranded and repositioned, where can we see this number going up to? What's the kind of growth that you expect? Because there is expectations of a higher RevPAR growth in the coming quarters.
So the RevPAR growth has remained, as you rightly said, in mid-teens for the last 3 reported quarters. I think we maintain our point of view that total revenue growth, which includes what's coming from rooms, which is reflected in RevPAR, and also which comes from food and beverage, right? The combined effect of that will deliver, as I said, between 9 to 11, 12% total revenue growth. We feel really happy with that because we have strong operating leverage in our business. So when the revenue grows at 10% year on year, we should expect the EBITDA to grow anywhere between 13 to 14% year on year. And that's something you see even in our last few quarters. So the total revenue growth will remain in that zip code of 9 to 11%. The RevPAR itself slightly depends on the segment and the cities you're in. And some of the cities like Bangalore and Hyderabad, where we have good inventory, we continue to add more inventory, are seeing mid-teens to high teens RevPAR growth. And some of the other cities are seeing high single digits to early double digits RevPAR growth. So that's very dependent on the city, but total overall business should deliver about 9 to 11% revenue growth.
Absolutely, that was quite informative. Mid-teen to high-teen growth is something that we can expect for the business going forward in terms of where the RevPAR growth is concerned. But coming to my next question is, with the renovations, with the upper upscale hotels inventory increasing in the next coming few quarters, want to understand from you, what is the revenue mix going to be like? Currently, if I look at the revenue mix, the 43% is the scale for upper upscale and upscale. So where do you see this number increasing to? Because that would lead to a downtick in the mid-scale segment. And also, if we can also talk about the Capex plans for the business.
So I'll first take the Capex, easier questions first. So in the current, the next 2 months, we expect we have only about 20 odd crores of capital expenditure, largely towards initiating the W in Hyderabad and the Westin in Bangalore. For the next fiscal year, we're targeting circa about 200 crores of capital expenditure, most of it going toward opening new inventory in Hyderabad and Pune. but also continuing to do work at the W Hotel in Hyderabad and Western Tribute in Bangalore. And then subsequently, we expect about an annualized 150 crores capital expenditure to complete the projects that we've just announced. So that's part one. In terms of impact of this on the overall portfolio mix, so as you rightly said, that currently about 45% of our total revenue came from upscale assets, and that's really doubling. So if we just see the total revenue per room in SAMI, and if we just kind of take the new inventory mix that we will have once we implement all these growth projects, we actually expect about a 35% increase in total revenue. And I'm not estimating any, I'm not, assuming any market growth in that. So just the portfolio mix change will itself induce about 35% or total revenue growth in SAMI because of the fact that we have higher upscale hotels in the next few years. In terms of contribution of upscale, we expect the upscale to go to about 60-65% in the short term. Just a word of clarification, we actually quite like the mid-scale space, and we believe in the long term, we'll maintain that healthy 50-50 ratio between upscale and the broader mid-scale. But in the short term, given how our portfolio is transforming, we expect the upscale to be at about 65% once Westin, W, and the Tribute hotels open.
Okay, so in near term, 65 and then 50-50 mix. Is that the correct understanding for SAMI Hotel?
That's right. That's right.
Okay. And considering the Capex plans which are ongoing, I want to understand, you are also focused on reducing the debt as you move forward. I want to understand what is the current debt like and how do you plan to decrease to? What should be the levels that we should look forward to, say, FY26 and 27?
Our current debt, our current net debt is about 2,000 crores. We expect that we will close the current fiscal year at about 4.5 times net debt to EBITDA. We have a stated target to get that down to about 3.5 times net debt to EBITDA in FY26. We are on track to deliver that. Actually, even this year, if we consider the amount of Capex that we've invested and if we kind of remove it from our overall debt, we should start touching about 3.8, 3.9 times at the end of March 31, 2025. So we expect to take it down to about 3.5 times net debt to EBITDA by end of FY26. What's causing that is the fact that we maintain pretty healthy cash generation from the business every quarter. The capital expenditures largely, being done from the internal accruals and the cash we hold on our books, and therefore there's really no increase in gross debt. And as we implement these growth projects and start getting income from them, and plus additional cash that we accrue because of the quarterly free cash that we have, we feel fairly comfortable to touch 3.5 times by end of FY26.
Well, that was an interesting conversation with SAMI Hotels, but as we wrap on this edition of Top Trades, with budget just being around the corner, NDTV Profit brings to you the wish list from various sectors, and our focus today is on the renewable and infra sector. Mihika and Anushi both are joining us to give us more details on what are the sector expectations from renewable and infra.
The Government of India's focus on renewable energy stands very strong, and our country has set some ambitious target of 500 gigawatts for 2030. Our shift to clean energy is no longer just a trend, but the transition cannot happen overnight, and it certainly won't be smooth without strong government support. We need a comprehensive energy transition policy to accelerate the transition while also making energy security of the country strong. So with the Union Budget 2025 just around the corner, here is what the analysts believe and industry wants for the renewable energy sector. Let's first start with 5 key expectations. This is spread across various sub-segments of renewable or clean energy. The first key expectation is higher capital allocation for the PM Surya Ghar Bijli Yojana scheme in FY26. The current allocation stands at 75,021 crores in order to install 1 crore household rooftop installations. More support for this program can benefit players like Tata Power, Waaree Renewable Tech and Adani Green Energy. Next, Jefferies awaits tweets on duties on solar modules and cells. Positive policies in this area could benefit Waaree Energies and Premier Energies. The third key expectation is for higher budgetary support for offshore wind energy. Carriage ratings note that incentives for project cost funding, larger turbines as well as mandatory sourcing from distribution companies could help the space. The need comes due to low developer interest in offshore wind despite the 6,853 crore viability gap funding scheme announced last year. The major driver for the low interest is the 2.5 times higher setup cost for offshore wind projects when compared to onshore projects. The fourth key expectation is for battery energy storage, an ecosystem that is key for 24/7 power supply. Nuvama expects the government to take measures for energy storage technologies. Carriage Ratings, on the other hand, notes that how domestic battery energy storage ecosystem can benefit from initial subsidy support via a PLI or viability gap funding schemes. The rating agency also adds how tax for crucial raw material imports can help adoption. Furthermore, it is key to note that media reports have noted a budget proposal which has been sent to the Finance Ministry, and this proposal includes a mandate for developers to establish battery storage facilities. The fifth expectation is for higher fund allocation for green hydrogen over and above the SIDE program. Current production costs for green hydrogen are not comparable despite government efforts, and this needs to be addressed. Nuvama also expects mandates for the use of green hydrogen, ammonia in key sectors like steel, refineries, fertilizers, and more. The government could also implement blending green methanol with petrol in transportation and other sectors by providing incentives for producers. This would help consumers adopt the fuel. And lastly, we also spoke to different companies operating in the space, so here's the industry wish list. As per Waaree Energy CFO, expansion of rooftop solar programs to increase adoption remains key. The company also mentioned how anti-dumping duties for solar modules and cells is critical to diversify and indigenize the supply chain and mitigate any short-term price fluctuations. Waaree Energies also notes how an increase of export subsidies on renewables from 1% to 5% will be a significant boost to the sector. Apollo Green Energy notes how the budget should address the need for modernizing infrastructure as the current grid stands outdated and ill-equipped to handle growing demands. Renew Power states that the budget needs to introduce focused funding for green skilling to ensure that India's workforce is prepared for the clean energy transition. And lastly, manager of O2 Power, which was recently acquired by JSW Energy, states how extending the conventional 15% tax rate under Section 115 BAB by 5 years would be a significant boost for the sector. The company's CFO also noted how the industry needs long-term financing challenges which have to be addressed. Well, that was what analysts expect from the budget 2025 for the renewable sector and what the industry wants. Stay tuned to NDTV Profit.
The Union Budget 2025 is anticipated to prioritize infrastructure-led sectors, particularly roads. While the Ministry of Road Transport and Highways has shown significant growth in recent years, certain challenges remain this year, such as project delay on revised cost of the Bharatmala project and Capex shortfalls. Let's delve into the key expectations from this Union Budget 2025 and recent developments that one should keep a track of. The government's Capex target for FY25 was Rs 11.1 lakh crore as per ICRA's expectations. The FY25 number would stand at Rs 9.7 lakh crore, missing this year's target by 13% and clocking in a growth of 2.4% on a year-on-year basis. The view, therefore, is that FY26 capital expenditure target will be set at Rs 11 lakh crore, similar to the FY25 target, which would thus lead to a 12 to 13% of an expansion over the previous year. With this growth case scenario in mind, the expectation is for a higher allocation towards infrastructure-led sectors like roads and highways. Do note that the road sector Capex in the FY25 budget was up 3% to Rs 2.72 lakh crore as compared to previous three fiscals in which we had witnessed a whopping 29 to 82% of a growth. In fact, of this budgetary support for NHAI, that's National Highways Authority of India, registered merely a 0.65% growth in the last budget as compared to 18% and 148% growth in the previous two fiscals. This again reinforces the government's stance of a more cautious approach on not intending to increase NHAI's debt. It is to be noted that the NHAI could not award any projects in the first quarter due to the restrictions on awarding imposed in the wake of the Model Code of Conduct ahead of the general elections. The NHAI hence started awarding projects only July 24 onwards. Thus, higher allocation is something we need to closely track for this upcoming budget. Higher focus on developing individual corridors is the second expectation we can track. In FY25, the Cabinet approved 8 high-speed road corridor projects spanning 936 km with a total capital cost of 50,655 crore. The length of national high-speed corridors has increased from 93 km in 2014 to 2,474 km at present. According to media reports, government plans 5 to 6% hike in highway budget for FY26, aiming to reboot infrastructure development after subdued performance in FY25. Now, coming to the key highlights of not just this year, but past decade, let's see what has happened. National highway network length rose 60% from 91,287 km in March 2014 versus 1.46 lakh km. 4-lane and above NH network expanded from 18,278 km in 2014 to 45,947 km. Length of national high-speed corridors increased from 93 km in 2014 to 2,474 km. On to performance in FY25 and other key highlights. Road awarding has remained tepid in FY25 owing to delays in approval for revised cost of the Bharatmala project. Construction of NHAI stood at 5,853 km till December 24 versus 12,349 km in FY24. Construction stood at 21.28 km per day till December 24 versus 33.83 km per day in FY24. Awarding stood at 3,100 km versus 8,581 km in FY24. At present, works in about 12,500 km NH length are under construction under national highways. This also includes Bharatmala projects under which 26,425 km has been awarded and 18,926 km has been completed till November 24. So that was the roundup on the infrastructure sector. Let's wait and watch if these expectations turn out to be a reality in the upcoming budget.
STT definitely needs to change.
Old tax regime.
The 1991 budget was truly a game changer.
I mean, the rest is history.
Union budget.
Budgets.
General elections.
Union budget.
2 more, Yashwant Sinha and P. Chidambaram.
Arun Jaitley.
Arun Jaitley, I'd have to say.
I think Manmohan Singh for sure because of the iconic 1991 budget speech.
STT definitely needs to change because now if returns are not that good, it'll start pinching people.
Income tax.
I think income tax because that's what matters to me.
Old tax regime.
Depends. Old tax regime currently.
I would say healthcare and education.
I'd believe infra.
Oh, certainly more allocation towards infrastructure. That's what's keeping the wheels turning right now.
Game changer, but not in a positive way, was the budget when farm loans were waived off.
There are a couple of them actually. 1991, Manmohan Singh, that was the budget which opened up the economy. Then 97, Chidambaram, who reduced the tax rate from 40% to 30%. In 2001, I think, if I'm not wrong, Yashwant Sinha, who reduced all the duties on customs that led to the computer age or the IT age taking off in India.
I think the budget in 2022 where Capex was done in a very big fashion.
There were several actually. 1991 was something that stands out, and I mean, the rest is history.
As I said earlier, Manmohan Singh's 1991 budget, I was a very young child at that point in time. But as far as I understand from reading about it and watching a lot of commentary from experts about it, 1991 budget was truly a game changer.
This is the day that shapes the future of 1 billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs and what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you.
I present the budget for a historic
Well, the union budget is right around the corner. It's a very interesting time leading up to the budget as well for the policymakers as well as, us as shareholders, because we see a lot of movement in the Nifty as well as speculations are rife with what could be some of the measures that are announced in this particular budget as well as has been in each one going into the same. We look at some of the key moves that have seen in the Nifty before as well as after the budget and get you some of the biggest measures that were announced in these budgets and what could have led to the strong Nifty reactions. Let's first look at 2024 because we had two budgets announced in this particular year. One was post the elections as well, and we did see a 1.5% move in just a week after, and that momentum was continued in the month as well. Leading into this budget, there were a lot of speculation, so we saw a downward reaction of the Nifty in the past week, and we did see some of the measures such as the standard deduction being increased to 75,000 for salaried employees from 50,000 earlier, as well as the new tax regime now and having tax-free status for up to 3 lakh rupees per annum for the investors as well. Apart from that, we saw custom duty reductions on mobile phones, gold as well as chargers as well. And these were some of the key moves in this particular budget. Leading up to the election, we had, the 2024 budget in February as well. Let's see some of the reactions as you can see in this particular time frame as well. One of the key moves was increasing the budget for capital expenditures to 11 lakh crores, the first and a very huge budget as well compared to the last decade. And we did see one of the positive reactions in the week and the month after as well. For 2023, it was a very budget going into this particular budget. Speculations were rife. We did see a negative 2% reaction just in the week before leading up to the budget as well. While the momentum wasn't very strong, and in this particular budget, we did see the new tax regime increasing the rebate to 7 lakhs. But apart from that, there were some continuations of policy measures, but nothing big to report as for. For 2022, it was a very interesting budget because we did see a strong reaction going into the budget just a week before by roughly about 2.5% on the positive side. But in the next week, as well as the month after, we saw a sharp reaction on negative 5% of the Nifty reactions. Some of the key measures were like they had involved rupees 2 lakh crores as additional credit to MSME firms. Apart from that, we also saw roughly 48,000 being allocated for building 80 lakh houses. But none of these measures could give the positive boost.
Welcome, you're watching India Market Close. I'm Mahima Vachrajani. With me is Hiral Dadia. Well, the markets today have been good in terms of the benchmark indices. The Nifty 50 is up around 1% as we speak. The Sensex is up 0.8%. The Nifty Bank, is up about 0.3%, but they've remained resilient today ahead of the budget. Let's also pull up the heat map and see how the contributors on the Nifty are looking like. There you go. It's a sea of green today, fortunately. And Tata Consumer Nestle, the consumer pack, is the one that's stealing the show. But let's cut into CEA, which is addressing. Let's listen to what they're saying.
Miss Chandni Raina, Economic Advisor Shri Anthony Syriac, Economic Advisor Dr. Anuradha Guru. Today's press conference will go as follows. First, the Chief Economic Advisor will give a presentation on the key narratives from the Economic Survey 24-25, followed by question and answer session. Over to Chief Economic Advisor, Shri V. Anant Nageshwaranji.
Thank you and good afternoon, everybody. Although we are almost at the end of the first month of the current calendar year, still 11 more months to go. I wish you all a very happy and healthy 2025. And I hope you had a good first month already. So we will go into the presentation on what the Economic Survey 24-25 is about. This is a presentation on the Economic Survey contents rather than on the state of the economy per se, although which will be there at towards the end of the presentation as well. The structure of today's presentation, we will cover the following issues: the changing global landscape and how India can raise the game for the new playing field. And in that segment, we will cover 4 areas, as you can see here: reform through deregulation, augmenting internal capacities for growth, the private sector's role in nation building, the energy transition the Indian way, state of the economy regaining momentum, and the growth outlook for FY26. Capacities for growth, the private sector's role in nation building, the energy transition the Indian way, state of the economy regaining momentum, and the growth outlook for FY26. The changing global landscape, we did cover that in the last survey as well. 2024 was the year of elections across the world. And most of us know that both qualitatively and in terms of quantitative dimensions, the world that existed between 1980 and you can choose the end point, some people would say 2008 or 2012, 16, etc. Roughly about 3 decades was the peak of globalization, hyper-globalization. As you can see in the statistics here, global exports went from 15% plus to 25%. Global FDI flows went from 0.5% of GDP to 3.75% of GDP. Global GDP itself rose 6 times in current prices. Extreme poverty came down because of faster growth in China and India. Internet penetration went from almost nothing to 23% as a share of world population. During this period, applied tariff rates across the world came down and the trade to GDP share went up. But clearly, you all know very well more than we do that this period has kind of ended. Even if we are not reversing very actively, we no longer are advancing along these dimensions. New import restrictions every year were of the order of about 3,000 restrictions imposed by countries across the world. They have jumped to about 5,000 restrictions in the last 4 years. And the key reason that is cited by countries in imposing restrictions is strategic competitiveness. I think that is the important theme that we have to internalize as a country, both in the policy space and in the private sector space. There is strategic competitiveness, so therefore efficiency considerations have given way to resilience and supply side security considerations. The value of trade covered under the new import restrictions was as low as $170 billion in 2014-15. Now it's more than $1 trillion, $1.3 trillion. So effectively, I think both import-export and investment flows are being looked at through the prism of strategic competition. And that is a new world which may be with us for quite some time to come, and therefore we need to get used to operating in this space. As a result, world FDI net inflows as a percentage of GDP has come down from around 5% in the first decade to around 1% of GDP. And world exports as a share of world GDP peaked, even though it may not have come down as much as investment flows have come down. Clearly, it is on a declining trend compared to the ascending trend we saw towards the end of the last millennium and in the first decade. One of the outcomes of the globalization era was also the rise of China as a manufacturing power. India also rose as a power in global services. So what has happened in the last 25-30 years, and it is continuing even now, is in several high-tech, medium-tech areas, the presence of China is pervasive and dominant, and the manufacturing as a share of world gross output, China's share will probably be higher than the combined share of the next 10 countries. It gives them a lot of strategic levers and advantage in several areas, as we will see later in some other dimensions as well. This is an important development along with globalization in the last 40 years. Now, along with the dominance in manufacturing, in terms of the materials and minerals required for global energy transition, let's first take a look at the solar energy. Global demand in 2010 was, China's share of the global demand was very small, and therefore China's production capacity in those areas was also quite small comparatively. But fast forward 11 years later, while demand has grown even within China, but the production capacity in that country has grown even more than demand, basically giving them an important lever in terms of the source of supply for all ingredients and components related to energy transition. And if you happen to see the September 2024 report of Mr. Mario Draghi on the European competitiveness, the entire 75-page report is full of European concerns about the concentration risk that is there with respect to one country as a source of supply for all critical components and technologies with respect to energy transition and manufacturing, etc. Moving on from solar energy to electric mobility, if you look at the key materials that go into it, copper, lithium, nickel, cobalt, graphite, and the rare earth materials, the dominance, and this is a slide which we have shown you back in July 2024 as well, the dominance of one country is quite clear. And in different stages of production, even if those materials are not mined in one country, the processing happens in a single country, and therefore whether it is the cell components or battery cells, in fact the truth is every single panel, solar panel we install, every single electric vehicle that we produce in this country, naturally the dependence on a single source for supply keeps increasing. So that dependence has to be kept in mind in the pace of transition towards renewable energies and also with respect to electric mobility. So this is the global context, that the era of globalization, faster and larger movement of trade and goods and services and investments is behind us. And there is a huge presence of a single country, a phenomena that we have not seen in a very long time, at least since World War II. So given this, naturally, we have to raise the game for a new playing field. The playing field has changed, and the game has to be rely on domestic drivers of growth. So what are those domestic drivers of growth? That is what is part 2 about. Just to recap, we do have a goal, a legitimate economic and social aspiration to become a developed country by 2047. The last economic survey broke it down into multiple components, generating about 80 lakh jobs per year, increasing our share of manufacturing in GDP, plugging Indian businesses into global value chains, and creating a viable small, medium enterprise sector, which in the German language is called the Mittelstand. Because countries that basically became powerhouses in manufacturing had succeeded in creating a viable small medium enterprise sector. Therefore, our goal with respect to manufacturing is inextricably tied to the success of being able to raise the share of SME enterprises as well. Therefore, what is the action? The action is we have to raise our game on domestic growth. And how do we do that? There are 4 dimensions to it. One is deregulation for growth, augmenting internal capacities for growth, the role of the private sector in nation building, and doing energy transition the Indian way. First, we start with the deregulation for growth. Now, when we talk of deregulation, it is not even big ticket deregulation or dismantling of the licensing era, which happened in 1991 and pursued by governments over the last 30 plus years. We are talking about the nuts and bolts or the plumbing of deregulation, which particularly affect enterprises, be they in services or be they in manufacturing, which affect them in terms of the time and the resource bandwidth that they have. And these are related to local level rules, laws, and regulations. So this is the deregulation exercise, which will probably not be a news story in the front pages, but that kind of deregulation at the local and the state government level have to happen pervasively for us not only to boost MSMEs, to boost manufacturing, but also to lift the potential GDP growth in the country.
So that's Anant Nageshwaran from CEA clearly indicating as to what's the roadmap ahead from here on. Clearly what he's indicated so far is that more than $1 trillion have been affected in terms of a value of trade goes, and this is on the back of restrictions. In fact, we need to go and up our game in terms of domestic growth as well. But the key that's coming from the economic survey is with regards to the GDP projections, and that's the crucial one that we need to watch out for. And the inflation, which has now softened to almost 4.9% in the April to December quarter, is what we are looking at. But the GDP becomes the key mahima, and from there on, what the commentary will be with regards to tomorrow, growth versus the Capex. That is what the street is watching out for.
Absolutely. The GDP growth for FY26 is expected to be between 6.3 and 6.8. And that's very big been given out, right? Yeah, absolutely. And in terms of an interesting thing that, even I observed was that for AI, they've spoken that, it's kind of, they are seeing a resource challenge when it comes to AI, which is one of those sectors which is, a booming one. But what they've said is that most critical obstacle is to large-scale AI in medium term, and resource efficiency is, at question right now. So that was also interesting. But with that, let's welcome in our guest for today. We have Ruchit Jain from Motilal Oswal joining us, and we're also joined by Ambarish Baliga, an independent market analyst. Welcome to both of you, gentlemen. Ruchit, I'll come to you first. With respect to the markets, how are you reading the Nifty and the Bank Nifty?
Yeah, hi, very good afternoon to all of you. Well, we have seen some pullback move in last 4 or 5 trading sessions, which was much anticipated because the global factors such as US 10-year bond yield and the dollar index have cooled off from their recent swing highs. But if you look at the FIS data, then still they have been selling in the cash segment and in the index futures too. They have rolled most of their positions on the short side. So I think until we see a breakout above the 200 DMA, that is 23,600 to 650 range, we are reading this up move as just a pullback move and not a trend reversal yet. Definitely, being a big event day tomorrow, volatility is expected to remain high on both the sides. So 23,000 to 22,800 would be the support zone, and whereas 23,500, 23,600 would be the resistance zone. So we expect markets to consolidate within this broad range, and any buying opportunity should be seen only on declines when we come near the support end of the range.
Interesting one, clearly, Ruchit. Ambarish, good afternoon and welcome to the show. Ambarish, my question to you is, have we hit the bottoms now? Because clearly, with the kind of downtick that has come in with regards to the markets, what is it that you're reading? Or do you think that the budget is something which will also probably play spoilsport further?
See, if we see in the last couple of years, the budget finally becomes a non-event.
So I mean, I don't see this year to be very different than that. Yes, we will have an effect of the budget for a day or two, but beyond that, I think people will forget about it and life goes on as normal. I mean, if you look at the macro numbers which have been coming, nothing too great. Earnings which have come for this third quarter, I mean, by and far, they've been a bit disappointing. There were a few surprises, no doubt, on the positive side, but mostly it's disappointing. So I really don't see, any of these really trying to push the markets up. I mean, we have seen an extremely good correction in the recent past. So a normal bounce back of, say, about 500, 800 points, I think that's quite normal. And that's exactly what we're seeing as of now. The way I see it is possibly post-budget, we could in fact seek lower levels. I'll not be surprised if we see levels of closer to about 20,000 or slightly below that. And that's the time I think it becomes decently priced and could be, good value. It could be a good value picking time at that point of time. Because when I talk of the Nifty going to 22,000 levels, you'll see individual stocks actually correcting much more. So that's the time I think one should be waiting for.
All right, Ruchit, quickly the bank Nifty, how would you trade right now?
I think one needs to be very specific within the banking space. I know there have been some signs of consolidation over last few days, and on the higher side, 49,500, 49,700 is the immediate hurdle which needs to be surpassed for any continuation of the uptrend. So as of now,